Everyone is starting to wonder if we are in the midst of another 2008 financial crisis. I can assure you, we are not. We are in fact on the cusp of a 1930s Great Depression. But unlike the last Great Depression, there will be no recovery and the jobs won't come back. People like to think of the 1930s Great Depression as an isolated event caused by the public's excessive speculation in the stock market. Everyone was invested and becoming rich. People were getting loans from the bank to invest in stocks because their stock portfolio was growing faster than the interest on their loans. People were getting rich. This newfound wealth leads to excessive spending in the economy, a positive feedback loop. Stocks go up, spending goes up, the economy grows, and then stocks go up, spending goes up, and the economy grows. And for a short time, it worked until everything crashed. In 1928, the economy that was built on the stock market was built on speculation and debt, and it was not sustainable nor real. The consequences were dire, with a 30% unemployment rate for years and Germany having hyperinflation completely destroying its economy, sowing the seeds for World War II. Millions of lives were lost in the coming years, all because the public got carried away. The market got drunk. No, this was not the public's fault. The market was drunk, but who was serving everyone alcohol? Maybe this was not an isolated event. To better understand the boom of 1928 and the bust of 1930, we need to look at 1918 and the end of the First World War. As we all know, wars cost a lot of money. Not only is it expensive to buy tanks, airplanes, guns, and bullets, but it takes away resources that could have been spent to grow the economy and increase people's standard of living. For a war effort to be successful, government spending must increase while tax collection must decrease, leading to huge deficits and large increases in government debt. This debt must be paid back with interest after the war is won. When the First World War concluded, the US government debt was at an historic high, especially considering that the US dollar was still derived from gold. Fortunately, the US government had a new tool in its toolbox with the creation of this new institution, the Federal Reserve, in 1913. The Federal Reserve played a major role in helping to finance the war effort. The Fed assisted in selling government securities to banks and to the public. The United States emerged from World War I with the world's strongest and most vibrant economy. The US economy grew at a modestly high and stable rate, with low inflation over the remainder of the decade. This allowed interest rates to remain relatively low during the 1920s. Comparatively speaking, the 1920s interest rates were about 4%, while the 1910s interest rates were about 8%. This was good because the government could easily pay off its debt that was used to finance the war. But this unfortunately led to excessive speculation that led to the Great Depression. In 1923, the Open Market Investment Committee was established. The Fed then began to use open market operations proactively to achieve broad economic objectives. The Federal Reserve started to realize their impact on the market, and this was the first time they tried to stop recessions from happening early by easing or tightening financial conditions. But this is just as smart as taking antibiotics every day so that you never get sick, where if you finally do get an antibiotic-resistant virus, you will most likely die because your immune system has no experience in fighting disease. Recessions are a natural phenomenon that fix the mismanagement of scarce resources in a capitalist economy. The longer you fight off a recession from happening, the worse the eventual recession will be because the greater the mismanagement of funds becomes. The Federal Reserve made substantial open market purchases in both 1924 and 1927 by lowering US interest rates. The purchases both prompted recovery from recessions in the United States. This was the first Fed put, because everyone in the market started to think that this time it's different. There will be no more recessions. Let's go all in on stocks and become rich. However, in 1928, the Fed's focus turned towards the booming US stock market. Officials debated what, if any, steps could be taken to ensure the Federal Reserve credit was not used to fuel financial speculation. The Fed sold government securities and increased reserve bank discount rates. So the Fed was tightening in early 1929. The Federal Reserve Board issued new guidelines intended to prohibit speculation using debt. The Federal Reserve popped the bubble that they themselves created by increasing interest rates from 4% to 6%, roughly speaking. This was mostly fine because the government had already paid off a significant portion of its war bonds and was no longer in such a precarious financial situation. This was not the case for the public, however. The Fed was courageous enough to raise interest rates. Imagine the Federal Reserve had become a cowardly political institution that just continued to lower interest rates from 5% to 4% to 3%, eventually to 0% because they were too afraid of causing a depression. The market would have probably continued to boom for another decade before completely imploding, potentially causing a much worse depression or a complete economic collapse. The US would have never been able to become the superpower that it is today. Today, the market is completely at the will of one man, Jerome Powell, and if he decides to raise interest rates, the entire global economy collapses because the entire economy is dependent on cheap money and the mismanagement of finite resources. But it is not Jerome Powell's fault. The financial problems that we face today started back in 2008, just as the 1930s collapse started in 1924. But unlike 1928, where the Fed purposely popped the bubble, the modern-day Fed and government decided to save the banks in 2008 and not have a depression. In the following years, they decided to lower interest rates and ease monetary conditions. They decided to further inflate the bubble because to pop it would be far too painful to bear. Today, it is much easier to do the wrong thing because money is not derived from a finite resource such as gold, but rather an infinite resource, debt, stealing labor from the future to provide liquidity for today. Economists and politicians believe that the US government can do whatever it wants because it has a money printer and they can never default on their debt. The arrogance of the US government and the Fed to bail out the banks in 2008 is because the Fed has become an increasingly political branch of government that looks at a short-term time frame instead of the long-term, and because the Fed believes its own fallacies that it can print its way out of any problem. Here we are 15 years later, and the chickens have come home to roost. Inflation became a major problem in 2021 and 2022, forcing the Fed to raise interest rates. Now we all know that COVID had an effect on the system, but the system is starting to break down. And now we are on the verge of another financial collapse that is starting to brew in the banking system, with the collapse of Silicon Valley Bank and Silvergate, and now Credit Suisse as well. There is only one question left to answer. Will the US and global economy face a severe depression due to deflationary pressures? Or will the US economy have severe inflation, wiping out the savings of millions of Americans to devalue their currency to be able to pay off the US's massive debts? In the next video, I will make a case for both arguments, so be sure to subscribe so that you don't miss that. Here is a summary of the timeline of events. In 1913, the Fed was created in the United States. In 1914 was the start of the First World War. In 1918 was the end of the First World War, and the US had the world's strongest economy and also a massive pile of debt. In 1920, there followed a short recession. And in 1923 was the birth of proactive monetary policy. In 1924 and in 1927 was the first time that this monetary policy was used to stop a recession. Market manipulation and low interest rates were used to boost the economy to avoid a recession. In 1928, there was an economic boom caused by stock market speculation using cheap debt. In 1929, the Fed raised interest rates and stopped debt-based speculation, thereby popping the bubble they created. In 1930, an economic bust and the Great Depression. In 1939 till 1945, the world economy was reset with the start of the Second World War. In summary, up and down cycles are a natural phenomenon in a capitalist system. During the 1920s, market manipulation exaggerated the cycle. To save the long-term economy, the Fed purposely broke the cycle which caused the Great Depression of 1930, which allowed America to regain its position as the financial world leader. Modern timeline. In 1998 was the start of the dot-com bubble. In 2000, the dot-com bubble burst, which led to slow economic growth. In 2003, the Fed lowered interest rates to stimulate the slowing economy. In 2004 and 2006, housing prices were climbing faster than mortgages, just as stocks grew faster than debt in 1930, creating a bubble. In 2007, the Fed unintentionally pops bubble by raising interest rates. In 1930, this popping of the bubble was intentional. Then followed the timeline where the Fed was trying to reverse their mistake. In 2008, banks were bailed out and interest rates were lowered, and it was the start of QE1, so the Fed re-inflated the bubble. In 2010, 12, and 14 was the launch of QE2, 3, and 4. The Fed was trying to prevent liquidity in the banks from drying up and trying to stop the bubble in the banking system from bursting. In 2021, COVID hit. Stimulus and supply chain issues caused massive inflation. 2022 and 2023, the Fed is forced to raise interest rates to try to stop inflation. Banks are due to collapse due to interest rate hikes. Trust in Fed is lost. Trust in banking system starts to break down. In 2024, the market will have to choose between severe depression or massive inflation. After the year 2024, there will be an AI revolution. Most jobs will be displaced, the middle class will be destroyed, and there will be extreme wealth inequality. Normally, after periods of extreme wealth inequality, there is revolt and war. If we are now, in fact, in a severe depression, the jobs will not come back. From 1930 to 1941, the Industrial Revolution was in full swing, displacing millions of families from blue-collar jobs. This is because recessions force businesses to replace expensive human labor with more cost-effective replacements so that the businesses can survive the recession, to more effectively use finite resources. Today, manual labor is not at risk, but rather white-collar workers, because they will be replaced by AI before this depression is over. I will end with a final quote. Those who do not learn from history are doomed to repeat it. My name is Jonathan, and I will see you in the next episode.